Good evening, ladies and gentlemen. Welcome to today's webinar where we are talking about investing out under one roof at fsm1.com. So to just run through the agenda for today, first off, we have Catherine Trapp, our Assistant Manager from Investment Advisory Team, to give you some tips to start up your investment engine. Then following that, we'll talk about an investment life story to hear some of the insights that we have from our Team Director from Etfs Global Markets, for Ko Yang-Zi, who will be joining us later. We'll also be sharing the best ideas that we have for the new year. And also lastly, we have Ron from our investment advisory team to share about our platform fsm1.com. So without further ado, let me just welcome our first speaker for today, Catherine Chua.
Okay, thank you, Sarah, for the introduction. So welcome our investors to actually attend our webinar this evening. So to start off with, my name is Catherine. I'm from the FSM1 Investment Advisory Team. So today I'll be actually sharing with you some investment basics to investing and also some of the strategies that we should adopt. And for those who are completely new to investing, I think this would be a very opportune time to actually learn about all the investment products in the markets and also what we do carry on the platform, and to note some key important points when investing in them. So first and foremost, before you start investing, we have to know that there's actually a trade-off between risk and reward, because investments that offer a higher returns would usually comes with a higher risk. So be it a potential loss of capital or to actually see your portfolio value plunges during very weak economy market situation. Yeah, so the higher the returns given is actually to compensate investor for the higher risk that they are taking. So I would do think that there's actually no best investment in the portfolio, but the best investment would be something that would be able to achieve your expected return within your risk tolerance. So I would think that knowing your risk appetite is first and foremost to the most basic part of investing, because this will determine the type of assets that you will be investing in, as well as your asset allocation strategy, which I will elaborate more later. So I also do recommend my investors, as in our investors here, to set aside emergency funds before they invest, because no one can actually predict like when an emergency would happen. And the last thing anyone should do or would want themselves to do is to sell an investment at a loss, especially when times are bad. Yeah. So based on knowing your risk profile, it will determine like how much you should invest into stocks or bonds. And this slide actually shows like a typical neutral asset allocation strategy. And also, if let's say we are in an expansionary phase, if you are, let's say, a balanced investor, instead of investing 50% into equities and 50% into bonds, you may actually allocate like maybe 10% more into equities. So adopting a plus 10% overweight in equities versus to bonds. So that's for a balanced investor. And this will be the same if we are in a contractionary phase, and we do think that if bonds will provide better value than equities, we will do the reverse, whereby 55% will be invested into bonds and 45% invested into equities. So in FSM1, we always advocate diversification as a strategy, because this combat market swings, and we can adopt this via a portfolio concept comprising of both stocks and bonds. So based on the current economic climate, we do suggest to adopt different weightage into these subsector, because different regions experience different economic growth rate. So by adopting a very globally diversified portfolio, it allows you to benefit from global economic growth without concentrating into a single type of investment asset or class, or if not, a region. So if you look at this chart of asset returns, it actually shows that there's no one investment that topped the market consistently. So we also want to imagine our asset allocation strategy like managing a football team. So equity funds are like your midfielders, while bond funds are sort of like your defenders. So for very high risk instruments such as like single stocks, single regions, countries, or thematic portfolio, we actually would view them more like the strikers in your soccer team, because when we are investing, right, the whole strategy is to cover your whole field, because it's very risky to only play with just strikers alone and without defending your goalposts. And also you cannot score goals if you are only having like defenders defending and not attacking. Yeah. So other than considering your portfolio diversification, these are other key investment strategies I would also like to share when it comes to investing. So first and foremost is that I would think that there's no, it's never too late to start investing, because there's a quote by Albert Einstein that the compound interest is actually the eighth wonder of the world. So if your monies are just sitting there idle in the bank account, the opportunity cost will be far too great. So as seen in the graph, it actually pays off to start investing early and let your return compound over time. So especially for young investors here who are with us today, I do think that especially if you are not looking at a steady stream of income because you're currently working or you're getting active employment, you are getting income, it'll be a very good habit to actually reinvest your dividends so that the returns can compound, and also your portfolio returns can be extended over a longer period of time. Yeah. And another strategy that we also advise clients to adopt is to review and rebalance the portfolio. So just like managing a football team, you have to review your players' performance and also take profit or cut losses when necessary. So for instance, if like a part of your portfolio, example in the equity portions, due to the bull run last year or something, it suddenly constitute a very large portion of your total asset. Like you may want to actually reallocate this profit and put it into other sectors that might be providing better value. And also for tactical asset allocation, we also want to review them more regularly, so that this to ensure that the ETF strategies or even the stocks that you are invested in, the company is still relevant, the strategy is still relevant, and so on. And also one of the more important strategy that we would like to advise clients to adopt is to actually dollar cost average, because markets don't move up in a straight line, and adopting like a regular savings plan, it will allow you to dollar cost average into your selected investments. So by setting aside a fixed sum of money and investing on a regular basis, allow you to buy more units when prices are low and less units when prices are high. And also when you are deploying money periodically, this also helps to remove emotional stress and also smoothen out your investment in the long run. So in this way, you can be always ensured that you will never be invested at the peak. And even if the markets go down, you will be able to have more ammunition to dollar cost average in more. And I would think that one of the more frequently asked questions that we do get in the investment advisory team is that, is this a good time to invest? So our reply is always that trying to time when the next best opportunity is and predicting the directions of market is actually very, very difficult, and it's a fool's errand, because it's very impossible to get it right 100% of the time, even for seasoned investor. And headlines every day sells us bad news. And I think if you are being affected by market noise, you will tend to be affected by making emotional decision, and maybe you might just be caught in buying high and selling low. Yeah, so once I chance upon this quote that says that your portfolio is like a bar of soap. The more you handle it, the smaller it gets. So I do think this applies to our investing portfolio as well. So I think staying invested is more important than knowing when to invest. Yeah, so after learning a very quick summary to like the basics of investing, I will go through like the types of investment products that we do have, and things that new investors or even seasoned investors should pay attention to. So one of the more popular product that we have on the platform is the stocks, because we do have a very cheap, very low trading commission. Yeah, so stocks are commonly known as equities. So investing in them basically means that you are a shareholder of the firm, and you own a portion of the business. So publicly listed firms can be traded on the exchange, and the prices are actually determined mostly by like demand of forces, demand and supply. Yeah, so factors like that affects the company prices are like their future earning potential, be it on specific news, general state of the economy, investment sentiments and so on. Yeah, so how do you get your investment returns through investing in stocks is that you get it through capital gains and or dividends. Because when company generates profit from their business, they usually tend to distribute a portion of their earnings to shareholders as dividends. So as long as you're invested in the stocks before the X date, you will get the dividends on the payout date. But also do note that dividends are not 100% guaranteed. Like for instance, Disney shares, they have stopped paying dividends since 2020. And till today, they have not resumed their dividends yet. And also, it's worth noting if you are new to investing, there's this thing called the withholding tax. If you are invested in US securities, you will be subjected to a 30% withholding tax, and this may actually further reduce your investment returns due to the amount of dividends you collect will be a lot lesser. Yeah. So, however, if you are investing in more of like the growth-centric companies, they tend to retain most of their profits, and also redeploy these monies into acquisitions or R&D or other expansion plans. So names like Tesla, Amazon, all these companies don't pay very good dividends. So as such, if you are investing in growth counters or typically the tech names, you will rarely see dividends, and most of your returns will be from capital gains since they don't pay out anything to shareholders. I think one of Warren Buffett's very famous investment philosophy is that investors should only invest in what they understand. So it's very important to know like the company you invest and not just hear guru on YouTube introducing them and you just buy into the company, because it's very important to know like what is the company's competitors, their sources of revenue, opportunities, risks that they face, and so on. And all this information can actually be found on the annual report or like their financial reports. So I think that there's no shortcut to investing. Definitely, if you're investing in individual stocks, it's very important to understand and do your own due diligence on the type of information that you need to get. Yeah. So moving on to the next investment product that has been very popular these days is exchange traded funds. We also call it ETF. So ETF are actually a portfolio of investment products that you can invest. They are listed on the exchange and they can be traded intraday. That means you can buy and you can sell on the same day. And most of the ETF out there, they are passively managed and they have only one job, which is to replicate the underlying index. So without an active fund manager, naturally, the cost of management is a lot lower. And also there's a high transparency because they are required to publish their day-to-day holdings on a regular basis. So one of the very important factor when it comes to investing in ETF, we want to take note of is the expense ratio. Why is this important? Because expense ratio is expressed as a percentage of the operating expenses to its asset. So the lower the expense ratio is, it also means that there's higher returns translated to you. And it's also very important to compare the ratios within similar asset classes and markets. So in this slide, I've shortlisted 3 ETFs that are commonly asked among investors that tracks the S&P 500 index. So namely, there's Vanguard, iShares, as well as State Street. So from this slide, you can see that Vanguard and iShares, they have a lower overall expense ratio that is 0.03 and is a lot more competitive compared to State Street one, which charges almost 3 times more in terms of fees wise. So the second factor when it comes to investing in ETF that we should pay attention to is the tracking difference. Because ETF, right, they are meant to mirror underlying performance of the index, but there are always factors that differ and causes such discrepancies, such as like your operating expense of the funds, your transaction costs, rebalancing costs, and so on. So all these prevents the ETF from replicating the index perfectly. So the wider your differences between the index and the ETF, it also means that the ETF is not copying it as perfectly as we desire. So for example, if you look at this chart, it compares the 10-year performance of the three S&P 500 ETF versus the S&P index. So you can see, right, the Stage 3 ETF, it has a tracking difference of 4.38%. So ideally, we want an ETF with a smaller discrepancy against the underlying index. So it means it tracks them seamlessly. So in this case, the Vanguard and the iShares do shows that it does a better job. So on the next factor about investing in ETF is that we always advise our clients to look at what is the underlying index. This is because, right, the index will tell us the constituents and also which asset class or segments is trying to replicate. And individual ETF will have their own methodology selections and rules to determine what will be inside or excluded from the ETF. And your monies will be invested accordingly to the weightage of these index component. So I just take a very popular ETF that we always often hear about, which is the Straits Time Index. It's a market capitalization weighted index that tracks the top 30 companies on STI. So knowing these top 30 companies, you will want to know what is the weightage of each. So for instance, like the DBS and OCBC and UOB, you will see that it comprises almost 45% of the index. So this means that for every $100 that you invest into STI, almost like $45 is invested into 3 local banks. So knowing what the index is will let you know whether or not your investment is it very concentrated in the financial sector or is it in the tech sector and so on. Yeah. And the next product that I'm going to share that we do carry on our platform is unit trust investments. So they are very much similar to an ETF. It's just that unit trusts are actively managed. There's a presence of an active fund manager, and also the portfolio managers can make decisions on whether they want to include a bonds or stocks, and they don't have to necessarily track a type of index. So for instance, like funds that are dividends focused, they will most likely include companies that are able to pay sustainable dividends. They will be able to cherry pick the amount of type of stocks or bonds that is inside the portfolio. Whereas like growth focused funds, for instance, they will want to shortlist companies that able to achieve a long-term capital appreciation for shareholders. Yeah, so this is like a comparison between unit trusts and ETFs, because both actually are able to give you diversification, but there's a slight difference because ETF having the absence of active fund manager, the fees are a lot lower. And I mean, there's no definitive answer whether or not like a ETF is better or unit trust is better. Ultimately, it really hinges on the fact which one do you think is more suitable to your portfolio? Are you looking at a passively managed return, or are you looking at someone who can cherry pick certain investments and were able to change their investment strategy based on the market condition and so on? So I mean, we could actually include both into one's portfolio. Yeah. So moving on to the next investment is actually about bonds. So bonds are actually issued by governments or corporation. They are basically like an IOU. So the borrower will pay you a fixed interest when you invest in their bonds, and these interests are also known as like coupon payments. So on maturity date, the borrower will pay you the principal amount, and during this period of time, you actually clip the coupon payment. So most of the time, right, bonds are often used as a portfolio stabilizer, especially for high investment grade bonds. So just look at this example during the COVID situation. When you look at SIA share price versus the SIA bonds, the SIA bonds only dipped like about a 3-4% during the sell-off during March 2020, versus if you look at the SIA share price, it actually came down almost 10 times more and declined almost 40% year to date. So in a sense, if you are invested in a SIA bonds, you will see a lower fluctuation, especially when things are going south. And also if, let's say, I mean, how you look at the bonds return is that if you buy at an IPO, you are buying at par, you'll be at 100. And if you are lucky enough and you pick up this bond during the COVID sell-off, you may actually buy it at 99.1. So not only means that you will clip the capital gain, you also get to collect the coupon of 3.16% across this period of time. So I would think investing bonds are very different from investing in shares, because as a bondholder point of view, you just need to make sure that the issuer has accessibility to the capital market. They are able to get finances, retap bonds, and also issue more shares, and major shareholders can step in to help. Versus if you are investing in shares, you want to look at more of earning potentials, and also if there's any competition in the near term or in the future. Um, Okay, so moving on to the last product, I mean, if you are still very confused about all the investments that we do have, you can actually refer to a managed portfolio here, whereby our team of dedicated portfolio managers and analysts will study every single type of unit trust and also ETF out there, and we will choose the right product for your investment portfolio, and we will digest all your global financial and economic data events, and also see when we will actually buy or sell the portfolio for you and the funds. Yeah, so this is more unlike other robo advisories out there. This portfolio consists of mainly unit trust investments. So getting started is very easy. You just need to choose your risk portfolio, and then you will determine the asset class that we will invest in. Is it more on the equity funds or is it more on the bond funds? And from there, you just need to choose whether you want to have dividends reinvested, or you want to have dividend payout quarterly to you. And after that, you just leave everything to us and we will monitor the portfolio. So getting started is very easy with just 1,000 Sing dollars for the portfolio, and you will be able to dollar cost average as well with just a minimum of 500 a month. And every quarter, if you want to know like all the portfolio actions, we will actually have like webinars to share about what is our outlook and positioning of the portfolio. Yeah. So with that, I hope a very short sharing actually covers about a very, very basic to investing, and hope you have learned something from here. Yeah, so I'll just pass the time to Sarah again.
Thanks, Catherine. So joining us in the next segment is Ko Yang, Team Director at Etfs Global Markets. So he's going to be sharing about his investing life story, and Catherine will be also present to just have a little bit back and forth about sharing getting how they got started in investing, his journey so far, and also plans going forward. So let us welcome Catherine back again.
Yes, thank you, Sarah, for the intro. Yeah, so it's me again, and happy to have Yang Zhi here from IGM in this. Yeah, so just wanted to find out more about like how you actually got started investing, and like where did the interest actually come from yourself?
Oh, okay. So I think after sharing a lot of very heavy informational stuff, I guess I'll go in a more informal way of sharing. So I hope you all can pick up some things from my sharing. So back to your question on when did I first start investing and what urged this interest, right? So I started investing in unit trust around close to a decade ago. That's about 10 years already. So back then I was a regular in the Navy. I wasn't with IFAS yet. So I read this book called Rich Dad, Poor Dad. So it isn't really an investment book. It's a book about money and business, right? So this actually sparked my interest in understanding about how money works. So in my pursuit to find out more about money, right, I read a lot of like articles and books and all. So I chanced upon this quote by Warren Buffett saying that, if you don't know how to make money while you sleep, you will work until you die. So that really, hit me. And then I was like, oh yeah, actually I never really thought about how I want to make my money work hard for me. I actually never thought about that question. So that day was like an aha moment for me. So I decided to pull the trigger, and then I tried my hands on my first investment. So the thing is that I don't know where to start. So I started by asking my friends, reading online, and then also speaking to various advisors about, how I should start my first investing. So I hope that answered your question. That's how I actually started investing.
Yes, that's very interesting. Yeah, I do believe a lot of people start out investing by all the hearsay, especially like
Mm.
now in terms of today's market. I mean, YouTube's and a lot of videos content
Yes.
available. Yeah, everyone can get started very easily. But I think what's important is to actually have like some kind of vision as well as a strategy plan out for the investment. So just wanted to check if did you actually start out like this? Like having a vision or any specific goals?
Okay, that's very interesting, right? So how I'm investing today and how I'm investing 10 years ago is vastly different. So when I first started investing as a new investor, I didn't really know what was going on. So when I spoke to friends and I spoke to even financial advisors, right? So they asked me, so actually what are you looking for? I told them my objective is very simple. I want something that give me the highest return the shortest period of time.
Yeah,
So
who
basically,
wouldn't?
yeah, so basically to answer the question, right, when I first started investing, I didn't have goal, I didn't have any strategy, right? I wasn't even aware of investment risks that buying into an investment, it doesn't go up in a straight line. There are times where it can go down and it can be very painful. So when I first invested, I wasn't aware of all this. My only thing was just give me something with the highest return. Yeah.
I see. Yeah, so maybe like for people who actually still very skeptical and can't really take the first step to investing, is there something that you want to like share with them and like from all your past experience, yeah, share like some of the lessons that you have learned?
Mm. So I think from my first sharing on why I wanted to invest, right? I think Warren Buffett's quote is very real, lah, right? That if you don't know how to make money while you are asleep, right, you'll work until you die. So that is, to me, that is very scary, and that is a very good reason that you start investing. But I get it that most people who are new, like for myself, I am a more aggressive kind of person, so I don't mind taking risk. But sometimes being overly aggressive, it may not end up very well for investing. So a lot of people who are hesitant are afraid to invest. Actually, is it because they are afraid of losing money? And actually, they are right because there is always risk in investing. So the thing is this, right? I always weigh the pros and cons. So today, if you invest, there is no guarantee that you will make money, right? But the thing is this: you can start small and you can learn to become better at the game over time. Just like when I started 10 years ago, I didn't know anything. But the thing is this, right? On the other hand, you have the other option, which is you just don't invest. So if you don't invest, what you are guaranteed, right, is that your money is going to lose to inflation. So when I was younger, I used to underestimate this word inflation. I'm thinking like everybody's talking inflation. Why is it so scary, right? I mean, today if I go to the hawker center and the auntie decides to sell me fishball noodle, right, at 10 cents more, it's not a big deal. So what's it with inflation, right? So I used to underestimate it a lot. But today when I look back, right, I think that inflation can be very scary. Because when I think back when I was a teenager, a young child, right, I remember that my father went to a hawker center, right, order a cup of coffee, 40 cents. So today, if I go to the same coffee shop, that same coffee, even the auntie that's serving that coffee is the same person, right? That cup of coffee today costs $1.20. So that is the 300% increase over the past 20 years. So today, if I'm not going to invest, right, yeah, a lot of my monies will be worth a lot less in the future. So I don't even know whether, 120 can buy that same cup of coffee 20 years down the road or not. So actually, the best hedge against inflation is to invest your money so that every dollar that you have can grow at the rate of inflation or higher, depending on how you invest. Yeah.
Yes, definitely. Looking at the housing prices these days as well is actually very
Yeah.
scary, especially like
So
last time,
expensive
like
now, right?
50, 100K you can get a house, but today it's almost like 5 to 6, 7 times the price. So just wanted to know, like, across so many years of investing, is there like changes to your investment goal, and also how is this like reflective on your investment portfolio now?
Yeah. So I guess now you all heard my very not so proud moments in the past, right? So when I first started investing, I shared with you all that I actually have no goal, have no strategy. So I just bought whatever was recommended. When I read an article online, I see that, oh, this seems good, I buy. When a friend says, oh, I bought this, it made money, I buy, right? So what happened is that I ended up with a lot of different investments with no coherent strategy. Sometimes it looks like diversification because I buy 10 different funds, right? But then if I look closely, right, all of them are buying in the same region or same sector. So there is no diversification at all. So the difference today is that I first start with a goal before I build my investment strategy. So I start with a goal, I build an investment strategy around it. So to put it in more literal terms, to help the viewers watching this, right, is that so I always explain it this way, right? You look at I look at where I am now and where I want to be, right? So where I want to be could be, retirement, it could be you want to achieve your first million. So that's where you want to be, and this is where you are now. So what I do is that I reverse engineer my goals to find out how much I need to invest and how much returns I will need so that I can hit my goals. So let's just say today, if I need 8% per annum to achieve my goals, right? I calculated and then I needed 8%. So what I'll do next, right, is that I'll research and then I'll build a portfolio that gives me the highest probability to achieve the 8% per annum. So I'm not looking for, 20%, 100% a year, but I'm looking for a portfolio that can give me the highest probability to achieve this 8% per annum so that I know that, in the long run, I will achieve the goal that I have in mind. So basically, that's how I invest nowadays. I try to start with an end in mind. Yeah.
Yeah, definitely. And I think, I mean, today, especially with a lot of informations that we have, especially, I mean, with IFAS and our research team, there's a lot more that we know, and we won't just anyhow buy because there's so much more information available on our website, as well as you can talk to all our advisors. They are a lot more competent as well to provide these kind of non-biased investment advice. Yeah, so I just wanted to know, like, is there any rule of thumb or strategy that you adopt during this kind of very volatile investing period? Yeah.
So when it comes to rule of thumb, right? It is very simple for me. I kind of had to learn it the hard way. Because when I first started, I shared with you all that actually I didn't really have any goals or strategy in mind. So I was trying to, I told everyone what can give me the highest return in a short period of time. So I ended up buying a lot of investments at the high because I heard people making money, I buy and then it dips right after. So I have this rule of thumb, which is the less you know, the more you diversify. So the baseline basically is global diversification. So today, if I am totally new to investing and I don't know what to do, what I do is buy all the biggest companies in the world. So I think one of our very good options was shared by yourself just now. I think match would be a very good option for global diversification. Then thereafter, right, once you understand the game already, right, that is when you want to go to the next level and then you want to challenge yourself and say, can I get slightly higher returns? That is when you need to do some homework, some research to, narrow down a little bit on the specific areas that you want to focus on. For example, this is what we call the circle of competency, right? So if it's tech is an area that you're interested in, you could look into that sector for opportunities. Or you're in the banking sector, so you understand the banking sector well, so you can look for opportunities there. So global diversification being the base. Thereafter, if you want to start, increasing your risk appetite and or investing more aggressively, you look into specific sectors. You do some research, and then if you think that this is a sector worth investing, then you put your monies in there. Of course, at the highest level of the risk, that is where you pick individual stocks, right? So from global diversification to a single sector that you're focusing on, and then finally a single stock. That is if you have really a lot of time to do the research and have high conviction for what you buy. Yeah.
Yeah, definitely. It's like building a pyramid, right? You want to start with the base. There's the biggest, take up the biggest chunk of the pyramid before you put all the cherry on top of the cake, and then you start building them slowly. Yeah, so that if there is like any corrections in the market, people won't just like panic because the tip of the pyramid actually occupies more than 3/4 of the portfolio and so on. Yeah, so talking about like roller coaster, especially when markets are volatile, is there any advice that you can give to like very new investors or like even seasoned investors who are just very afraid of volatility?
Yeah, I think this is pretty apt because we are at a time where in January, I'm not sure if the people listening to this are invested in the US market, because if they are, this will be very relevant. I think in January we saw that the S&P came down about 9%. I believe it's a correction from its all-time high, and then the Nasdaq is down something like 15% year to date, if I'm not wrong, right? So I think people get emotional because they check their accounts too frequently, right? So so think about this, right? If we are buying stocks like we are buying property, we will not feel that panic. So think of it this way, right? Today, if you're gonna buy a property, let's say you want to buy you just your BTO just finished 5 years, and then you're looking to shift to another HDB or another condo. What do? So before you buy the property, you will survey the area. You'll check what's coming up in the area. Is it near MRT? You're gonna build a supermarket near there? How is it like? So if you like what you're seeing, right, and the price is okay, then you buy the property, right? So that is how you invest in property. That is the same mentality to researching about your investments. And then the thing is this, right? You don't check the price of your property until like 5 years later when you want to sell it. So the funny thing is this, right? Because people don't really have the option to sell the property so frequently, sell and buy property so frequently, so they don't check the price. Whereas for stocks, because you can trade it daily, people tend to look at the prices every single day, and I think that is the source of the panic. So if we can take the same mentality of like property investing to investing in your funds, your stocks, your bonds, right? I think that will be good, right? Because if you buy into good businesses, right? Good businesses that can generate good profits year on year, right? The prices eventually go up. So if you're buying into things like the S&P 500, you're buying into an index fund, what you're essentially doing is you are buying into the biggest companies within the US. So yes, it can be down 15% now, but the thing is that moving ahead, will they do very well in the next 12 months? It is anybody's guess. But if you're going to ask me, is US going to be in a better position 5 years from now as compared to today, right? I think the answer is yes. So again, right, I think the real question, an investor, if they are panicking, the real question they have to ask yourself, right, is that if you bought a business, a stock or a fund, everything, right, is this stock that you're buying, is it going to be more profitable 5 years from now or not? So if the answer is yes, right, then actually why are you worried about this short-term dip, right? Yeah.
Yes, definitely. I mean, market volatility sometimes even scare myself as well, especially when I log into my account. And yeah, I mean, with all the market noise, sometimes it's very hard to filter out like what is important, and also like what is more of the critical information that we should pay attention to. And should we just hear all the gurus in the market that say, oh, there's a next crash coming? But how many times have you heard this across the last like 2-3 years, right? Everyone
Yeah,
is saying the same thing. I mean, since the beginning that I started my investment journey here. Yeah, so I think just to wrap things up, I mean, because we don't have much time left as well, maybe like can you like just share with us like some important decisions that you have made last time, and also all your positioning and thoughts when it comes to investing?
Okay, so I think that the key thing that I have, I mean, when it comes to investing, it's a very, very huge topic, and we can really go on and on. But I think the most important lesson that I have learned is to master your emotions, because end of the day, investments don't make mistakes. Investors make mistakes. So whatever you do, right, whether investments do well or not, right, it is pretty much dependent on your decision making. So two people buying into the same investment can have very different outcomes. So you can have two people buying into the same fund, but because of how you decide, one person can say, I buy S&P 500 and hold for 5 years, 10 years, and then this person make money. Another person can also be buying into S&P 500, but then they just started investing, and then recently there's a correction, and then they sold, right? So the result can be vastly different. So I guess if there is one important lesson to share, I think that would be to manage your emotions, because that will be in the longer term, that will be the biggest driver to your portfolio performance. Yeah.
Yes, yeah, especially the quote that I mentioned earlier. I think like portfolio is like a bar of soap. So if you keep handling it, the smaller you will get. Yeah, and I think time really do generate more returns in the market in the long run lah. Yeah, so maybe for the very last point, before we just wrap this up, is there like anything that you have yet to dabble in for the coming year, and you are actually looking at it to put it inside your own personal portfolio?
Oh, okay. That's very interesting. Okay, this is not financial advice. This is just my opinion. Okay, so I believe in the next 10 years, I think technology will change our lives in ways that we cannot even begin to imagine. So, if you're talking about a sector that I'm looking at now, I'm very interested in metaverse-related companies. Okay, so there's a lot of hype around it, right? So when we talk about metaverse, people think about the virtual reality goggles, right? The Facebook Oculus. So in fact, I think that we are at a very initial stage of this metaverse, right? And the VR goggles that we are seeing today, it is like the Nokia 3310 in the smartphone era, right? So this is what I think, right? I think that in the future, we could be looking at things like mixed reality, where the virtual world and the physical world is kind of like interlinked. What will happen is that there will be a digital overlay on physical items and physical spaces. So besides things like gaming, right? So people always associate virtual reality with gaming, but I believe there'll be real life applications, such as your virtual concerts, remote surgeries that surgeons can actually use all this technology to perform, or even help retail stores to sell their products online in a more interactive way. So with the metaverse, it basically you don't have to go and visit the store. You don't have to go to the concert. The concert comes to you. So you can get connected wherever you go. So I think this will be very amazing, and that would really change how we live our lives very drastically. But that will probably be like 10 years from now. Yeah.
Yeah, I guess for investor with very, very long investment horizon, they can definitely consider like the universe of the metaverse. It's like basically another realm. Yeah, even like I think property agents as well. I think
Yes.
especially in the States, they market their products using VR, so you don't really have to be there to visit the property and
Exactly.
so on. Yeah, definitely a very interesting space to pay attention to.
Yes.
Yeah, so with that, I will just wrap up our current session. Yeah, just hope all of you learn something from like our investment stories. Yeah.
Thanks, Yang Zhu and Catherine, for the insightful sharing. So next, we have Cyrus Ng, who's an analyst at our research team at IFA Singapore. So let us welcome him.
And hi, and good evening to everyone. I'm Cyrus Ng from the IFA's macro research team. Today, I will be sharing my views on the best markets to invest in 2022. So if you are looking and wondering what are our key investment themes and ideas for 2022, stay tuned for the next 20 minutes or so. For today, we'll start off with two broad themes. The first theme is why we think equities are more attractive than fixed income. And the second theme, we'll summarize the discussion on inflation and interest rates in the US. After that, we'll look at major developed and emerging market equities, as well as fixed income, both investment grade and high yield. Starting off with our first theme, we think that fundamentals remain very supportive for equities in general. Also, on the pandemic front, we remain very optimistic because the Omicron variant has so far looked less deadly than the Delta variant. And vaccination rates are climbing around the world in both developed and developing countries. So specifically, we saw vaccination rates climb quite fast in Asia in late 2021, such as in Japan, which now has about 80% of its population fully vaccinated. So we think that the global economic recovery is set to continue in 2022, led by Asia as the region and the world reopens as a whole. So overall, if you look at the graph on the left, we see GDP growing at about 4.4% this year in 2022, which is a higher figure compared to the previous years, you can see. Similarly, we expect company earnings, if you see the graph on the chart on the right, to follow this economic recovery and grow strongly in 2022. Overall, we expect global earnings to remain strong at about 7% this year, and basically, in all, just remain very positive in both 2022 and 2023. As for fixed income, if you look at a graph, they actually didn't perform that well in 2021 itself. And we think that in 2022, they will still continue to perform worse than equities. So there are a few reasons for that. First, we think that a lot of segments within fixed income offer a limited value as credit spreads are trading very tightly. So in other words, the credit spread trading tightly means that when bond investors, could be you or me, are not getting compensated a lot for taking on the risk in buying the bonds in the first place. So that's not a good thing. And the second thing is that yields are very low compared to history right now, meaning that the amounts you earn from both capital appreciation and both the coupons in total has very limited upside for a lot of fixed income segments. And finally, we think that the macro backdrop, namely Fed rate hikes and inflation, will also continue to adversely affect fixed income, and we'll discuss that in later. So onto this inflation and rate hike topic, we know that countries around the world are facing very high inflation, partly due to higher food and energy prices, even in Singapore itself. So if you look at the graph on the left, US CPI inflation, consumer inflation, has remained above 5% for the past for the second half of 2021. And data is also showing that inflation is in the stickier components, such as wages, components that generally don't go down as much, meaning that inflation could remain high for an even longer period of time. With inflation looking to remain sticky and high, central banks will generally look to hike their interest rates. So for example, the Federal Reserve, which is a central bank in the US, is about to start hiking rates this year, and markets are expecting about 3 to 4 rate hikes this year. And even JP Morgan CEO has said that there could be up to 7 rate hikes in just 1 year. So this is a lot. And generally, when there's a rate hike environment, fixed income assets will suffer more. And this is for 2 reasons. First, when you have high inflation, the real value of your coupon becomes becomes lower, and therefore the coupons become less attractive in general. And secondly, when you have high interest rates, your fixed income bonds will look relatively less attractive because when you have high interest rates, the coupons of your bonds are generally fixed there. So compared to, let's say, maybe your savings account, or maybe even your savings account or your equities, relatively speaking, they might look less attractive when interest rates goes up. So that concludes our 2 themes, and now we'll move on to equities in the first place. So first, for the equity segment, we'll look at developed markets. And the most common markets that investors invest in is US equities, American equities. US equities had quite a good run last year amidst easy monetary policy, a strong, robust economic recovery, as well as strong earnings growth. However, we think that valuations remain a key risk for us. So if we look at the graph shows the forward PE ratio. So a PE ratio is one way to determine whether stocks are expensive or not expensive at the moment. And it stands for price. It's just the price of the share divided by earnings per share. And right now, if you look at the graph, this PE ratio is very high compared to history. Even with the recent correction in US equities in the past 1 to 2 weeks, based on this forward PE ratio, we are still trading at about 10% premium compared to its historical average, which is quite a lot, which means that based on the expected earnings we are going to get, we are not getting a very cheap price for it at all. And with markets, and part of it is because markets are very positive on earnings. They think that earnings will keep growing and growing and growing at a very, very fast rate, which explains why valuations are so expensive. But there's a risk in that, because if earnings disappoint, then we might see a valuation contraction. So companies are facing higher costs, and we see that earnings momentum is actually fading. In one of the bigger headlines earlier this week, we actually saw Netflix go down quite a bit because it missed the earnings report. And Netflix is actually down over 45% from its peak just 2 months back. So we think we may see a similar but maybe less drastic trend in US, and overall we see a pretty low upside potential for US equities based on our fair valuations. And we will suggest some other options later, but overall we recommend you to underweight the US and choose other developed markets to put your money in. So one example of what you can put your money in is European equities. So European equities, we think, look more attractive. And even though they had a challenging month in December due to Omicron, we like it because it's a very attractive cyclical play on the global recovery. So if we look at the pie chart on the left, and we look at the composition of sectors in the Euro Stock 600 index, they have a high proportion of cyclical sectors, things like industrials, financials, consumer discretionary. So cyclical meaning as the economy improves, as income levels increase, these stocks tend to do even better than normal. So with this pro-cyclical tilt and relatively dovish monetary policy, which we'll explain later, we are more positive on European equities. And we think that earnings should grow strongly as well. So previously we talked about valuations. Valuations is a very key part of what we look at when we do our research on different markets, different equities, and so on and so forth. And unlike the US, we think that European equities still have quite attractive valuations. They are decent on a historical basis. Right now, their forward PE is about 15.5 times, which is lower than our fair PE of 16.5 times. So about 10%-ish. And if we look at a graph on the left, we can see that in terms of the price ratio, it has flattened out, meaning that Europe and US, the price performance has performed roughly the same. But the PE ratio, you can see, has gone down significantly for Europe. And that means that earnings performance in Europe has actually been pretty good, better than the US, but their prices have performed about the same. And therefore, we think that on a relative basis, if you compare Europe to US, Europe looks to be much more attractive, both compared to US and compared to its own history. And we see about a 13% upside potential by end 2023, which is higher than what we saw in the US previously. The last developed market we want to look at is Hong Kong. So Hong Kong performed quite poorly in 2021. But we note that despite the poor price performance, actually earnings have not really materially worsened. In fact, they have been revised upwards, and earnings growth itself and earnings growth forecasts still remain very strong. So we expect both tech giants and the Chinese financials to both perform very well. And these two segments are very important to the Hong Kong equities, and they occupy a big proportion of the Hang Seng Index. And furthermore, we also note that Hang Seng Index is actually undergoing a reform. So part of the reform is to include more constituents, and more importantly, in our opinion, is to include more new economy stocks. So these new economy stocks generally will have higher growth potential and will help to boost earnings growth in the longer term for Hong Kong equities and Hang Seng Index. So to sum up, we think that Hong Kong equities demonstrate high growth and low valuations, which is honestly a very good combination of characteristics you want to have in your investments. And we see more than 40% upside by end 2023. So those are the developed markets, US, Europe, and Hong Kong. We are most positive on Hong Kong. We are fairly positive on Europe, and we are underweight the US. So let us move on to emerging markets. First, we look at Chinese equities. So for China, we note that growth has been slowing recently in terms of economic growth, but authorities are already looking to loosen their policy and boost growth. So that can come in terms of government spending as well as lower interest rates, which is opposite to what the US is doing. And one important concern for Chinese investors last year was industry regulations, such as on Alibaba. And we think that the tightening of these regulations has moderated. While it may remain, we think it will ease in 2022, because again, with the slowing growth in China, the government doesn't want growth to slow down too much as well, because there's a trade-off between this regulation and growth. and they might focus more on loosening regulations, ensuring that growth continues at an okay pace before continuing their regulatory movements. Furthermore, we think that in terms of GDP and earnings estimates, we think that there's potential for upwards revision, especially because the COVID situation there is is more severe. As in the COVID situation there is tough because they have imposed very tough restrictions. There's a lot of room for them to loosen restrictions over time. And the same for the property sector. It suffered quite a bit with some defaults along the way. But we think that the government is already stepping in to solve these problems. So overall, in terms of COVID, in terms of property sector, equities have already priced in a lot of this negative news. And we think that with so much bad news already priced in, they are not pricing enough of the good news. And one of the biggest news we think for Chinese equities is that valuations are very attractive. And this is considering, as what we mentioned earlier, strong earnings growth. So again, based on the price to earnings, PE ratio, we see a very attractive upside potential of almost 40% by end 2023, which is again much higher than, let's say, the US, which we mentioned earlier as something underway. Another emerging market we want to look at is Indian equities. So overall, we think that they have pretty strong growth prospects, and they recovered pretty well in the second half of 2021 with a strong rebound in macroeconomic data, as well as earnings data from company level data. However, we think this is a bit of the opposite of Chinese equities right now, because a lot of these positive news in terms of what we mentioned about macro data, earnings data, has already been baked into equity prices. Right now, if you look at the chart, the line chart on the bottom, valuations are at an extreme at the moment. They are very expensive relative to history and compared to their emerging market counterparts. So for example, based on PE ratio, their price to earnings ratio, they're trading at about a 40% premium compared to their own 10-year historical average, which means that they're very vulnerable. If something goes wrong, valuations can contract very easily. But despite all these high valuations, we think that the long-term growth potential of India still remains, especially as China develops further and the global supply chain gradually relocates from China towards India. So right now, we are quite neutral on Indian equities. We think that valuations are quite expensive. But once valuations go down and become more reasonable in the future, maybe one or 2 years or so, we may revise our stance, and we recommend that for you as an investor, we don't think that now's the best time to go in, but we will monitor and we'll let you know when it becomes a better time to go in. So those are equities. We covered a mix of developed and emerging markets. So usually your asset allocation will have a mix of both stocks, equities, and fixed income, which is bonds. And now we are talking about bonds. There are two main types of bonds. The first is investment grade, which are usually safer bonds with a lower default risk. So for investment grade bonds, overall, corporate fundamentals and macroeconomic factors are both very supportive, but spreads are extremely tight. So again, this means that so spreads in this case refer to the yield of your investment grade bonds over a riskless asset, which means essentially is how much are you getting paid to take on the risk of the bond. And when we say spreads are extremely tight, it means that you're getting paid very little for the risk you're taking on the bond. So if you look at this bar chart on the left, you can see that the currents, which is the diamond, is near the bottom of the min-max range, which means that relative to history, you're really not getting paid much. And partly this is due to bond yields being at historical lows. And as a result, with yields very low, with high inflation lowering your yields even further, and treasury yields, which is the risk-free rate, going up, we think that investment grade bonds will face challenges in 2022. So, but however, if you want to invest in investment grade bonds in the first place, we think that the best chance of earning a decent yield is in the Asian investment grade space. So this is one of the few IG segments which provides relative value. And if you can see on the graph on the right, they actually offer quite a good spread over the risk-free rate, about 200 basis points or 2%. So again, this is reflective of how much risk you are willing to take. And we think that right now credit fundamentals have stabilized, meaning that we think even though you're getting paid quite a lot because people think Asian IG bonds are risky, we think that in actual fact, the situation has definitely improved since, let's say, 3-6 months ago, and therefore there might be some opportunity for you to enter here. These bonds usually have a higher yield and shorter duration, meaning they are also less affected by any interest rate hikes that we mentioned earlier. So overall, within the IG space, we do like Asian IG bonds the most. Finally, let's look at high yield bonds. So unlike IG bonds, high yield bonds tend to be slightly more risky. They are based on a rating system by several rating agencies, and these tend to be more risky, but they also offer higher yields, as the name suggests. We think that overall, these offer a more attractive return potential, again, due to supportive corporate fundamentals, and as well as the good liquidity backdrop, meaning easy money flowing around in the markets. And overall, because they are higher risk, they tend to have higher absolute yields. And we can see that there is room for credit spread compression, meaning if you look at the chart at the bottom, remember the diamond was very low for the IG bonds. But if you look at especially the Asia high yield chart, actually the spread you're getting is not that cheap. It's not that little compared to history. And overall, and this is a good thing, because it means that you're likely getting adequately compensated for all this risk that you're taking. And overall, we think that people are looking for higher yields in different places, whether it's in stocks, whether it's in these type of high yield bonds. So with supportive fundamentals, we should see more demand and flows into these high yield bonds. So one thing we want to note if we invest in Asian high yield bonds is that a lot of these bonds are property sector names in China. So you might have heard in the second half of 2021 that there was some pressure in the Chinese property sector. While we do not rule out further defaults, we think that risk on the whole should be manageable, especially as the government and authorities in China are already looking to stem this sort of wave of defaults, recent defaults. So right now, they're trading at a spread of about 8 to 9%, 800 to 900 basis points, which is quite high, meaning they're paying 8 to 9% over the risk-free rate, which means it's actually more than 8 to 9%. And we think that overall, a lot of the bad news in property sector has already been priced in. That's why you are getting paid 8 to 9%. And if the situation gets better, you are getting a better deal for your for this 8 to 9%. So overall, we like it, and we like Asian high yield, especially in the high yield segment. And we think that it will offer strong yields and strong return, especially because of its high yield to duration. So to conclude, let's recap what we think we should invest in 2022. So overall, we started by saying that we should overweight equities over fixed income, meaning, for example, what Catherine mentioned at the start about a balanced portfolio having 50% bonds and 50% stocks. We might go 55 or 60% stocks instead, and about 40% bonds. And that's roughly what we mean by overweight stocks. The second theme is about inflation and high interest rates. So what you need to know is that in such an environment, usually fixed income doesn't perform well, which is the reason why we prefer equities in 2022. So within developed markets, we are underweight the US, and we are more optimistic on Europe and much more bullish on Hong Kong. For emerging markets, we like Chinese equities and not so much of Indian equities at the moment. For fixed income, While we are generally underweight fixed income and bonds in general, we prefer Asian bonds, especially Asian high yield, due to supportive fundamentals and higher yield. So that concludes my presentation for today. Thank you very much.
Thank you very much, Cyrus. So let's go on to our last segment before the Q&A session. So after hearing all the ideas as well as the tips in the earlier segments, let us now welcome Ron Ng from our investment advisory team. He'll be sharing about how you can have all your investments under one roof at fsm1.com. Ron, please.
Okay, thank you, Sarah. So just let me share my screen first. Just give me a while. Okay. So hi, good evening, everyone. This is Ron from the FSM1 Investment Advisory Team. So as my colleague Catherine shared earlier about some of the investment strategies, my presentation would focus more on products and services offered by FSM1. So in a nutshell, the products Catherine shared previously are all available for investing on FSM1. And for those new to our platform, I will now go through some of the minimum investment amount and pricing structure for each product. So unit trusts are available for investment via a lump sum one-time investment or regular savings plan. Starting this year, we have also adjusted most of the minimum lump sum investment amount to $100. So for Ang Pao monies collected this year, you can start an investment with us instead of putting it in the bank for negligible interest rates. Also, we do not impose any upfront processing fees for unit trust purchases. So 100% of your capital is deployed into the market directly. We do charge a platform fee of 0.05% per quarter for bond funds. For other funds like balanced or equity funds, it will be 0.0875% per quarter for the first 300,000, 0.05% for amounts above 300,000. And if you're a diamond client with more than 500,000 worth of assets with us, not limited to unit trust funds, the platform fee for unit trust is fully waived. Okay, next up to ETFs. So ETFs are also available for lump sum and RSP investments. However, new investors should take note that minimum investment amount would depend on the lot size that the ETF is listed on. So for ETFs listed on the SGX and the US markets, lot size for ETF is typically one share unless otherwise stated. And lot sizes for Hong Kong Exchange, it varies between 10 shares, while some can be 100 shares. So all this information will be available on each individual ETF's page. So processing fees wise, it is 880 Sing dollars flat for SGX buy and sell orders. For Hong Kong Exchange and US markets, it is 0.08% or minimum 50 Hong Kong dollars and 880 US dollars respectively. For RSP buy orders, it is usually 1 Sing dollar, 5 Hong Kong dollars, and 1 US dollar for the three respective exchanges. But we have announced during our recent What and Where to Invest 2022 that we are bringing down the processing fees for ETF RSPs to 0% for the entire year of 2022. So if you have been considering whether it's time to start your investment journey, now would be the great time to do so with FSM1. Do note that exchange-related charges would apply for both lump sum and RSP investments, and you may visit fsm1.com for more information about these charges. Next, stocks are actually similar to ETFs in terms of minimum investment amounts and charges applicable. So just note that SGX lot size for shares is 100 shares instead of one share for ETFs. So in this case, you can buy one share of Tesla, but not one share of DBS. Okay, moving on to bonds. There are typically two types of bonds, retail and wholesale. So retail bonds generally start from $1,000, and for wholesale bonds denominated in SGD, investments start from 250,000 Sing dollars nominal value and 200,000 US dollars for bonds denominated in USD. For bonds, there is a processing fee of 0.35% for both buy and sell orders, as well as platform fee of 0.05% per quarter. One thing to note for new investors into bonds is that unlike stocks, bonds are not traded on exchanges since there's no bond exchange in Singapore. Hence, if you would like to buy a bond on our platform, our dealers will actually contact counterparties to source for the bond for you. So all bond trades are considered over-the-counter trades, or OTC for short. So like my colleague Catherine mentioned in her presentation, financial jargons or certain market news can be daunting for some new investors. However, we feel that that should not discourage you from investing, taking your first step into investment. So with our managed portfolio solutions, MAPS, you can achieve a diversified portfolio right from the start instead of having to assess different stocks, funds, or bonds before crafting your own portfolio. We have 5 different risk levels to cater to investors with different risk appetite. So if you're unsure of your own risk appetite, do make use of the risk profiling questionnaire on FSM1 to better understand your risk profile. For managed portfolios, there is a management fee of 0.0875% per quarter for the conservative portfolio and 0.125% per quarter for the other 4 portfolios. Now, from the start of the session, we have mentioned about RSP quite a number of times. And if you're still unfamiliar with how an RSP works on FSM1, just understand that it is a monthly contribution plan where we can either deduct the monies from your FSM1 cash account, or do a direct debit from your bank account to buy into the product of your choice. So there's no lock-in period for RSP, and you can adjust your monthly contribution amount anytime. Furthermore, we also provide complimentary advisory service for new investors to start your initial portfolio. And also investors can initiate discussions to review their holdings with us. And for portfolio reviews, we generally recommend doing it once a year. And there are some tools and functions you can utilize on our platform to help you make a better investment decision. So tools such as Fund and ETF Selector, where you can view and compare each fund's information and track record. Stock and ETF Calculator, where you can calculate the total amount for consideration, including all relevant exchange fees. And finally, Bond Selector, where you can search for bonds that suit your investment profile. So for Fund Selector, you can make use of this Fund Selector to compare unit trusts and ETFs at the same time. So in this example, if you're an investor who wish to compare the past performance of a US equity unit trust versus a US equity ETF, you can see that the ETF, the expense ratio of the ETF is lower compared to the unit trust. And also, the ETF paid a 1.25% dividend yield over the last 12 months. You can also compare the past performance over a 10-year period. And for the visually inclined investors, there's also a nice graph for you to refer. So when I mentioned earlier that there are some exchange-related fees payable for each trade, they will be reflected in the stock calculator as highlighted in the slide. And you can also see that the investment amount is indicated clearly. Similarly, for the ETF calculator, exchange-related fees are calculated and presented together for your consideration. So finally, to search for a bond on FSM1 that suits your investment criteria, do make use of the Bond Selector. It lets you filter various fields such as yield to maturity or in years to maturity, so that you can generate a list of bonds that is most suitable for you. Well, we can go on and on about the resources available on our website, but we understand your time is precious. So if you have any queries that we didn't manage to cover today, feel free to reach out to us via these channels. Okay, back to you, Sarah.
All right, thank you, Ron, Kashmir, and Cyrus. So I think we can wrap off the webinar here. So just to share a bit more, as mentioned by my colleague Cyrus, that our website, www.fsm1.com, we indeed have a lot of research ideas over there for across various products like bonds, funds, stocks, ETFs, managed portfolios, and so on and so forth. So if you actually want to keep updated of the latest news that we have, or even upcoming events like this one, you can subscribe to our e-newsletter, and every now and then you'll receive information about these upcoming events, updates, and you can stay tuned to all these happenings on fsm1.com. Yeah, so with that, we'll end off here. We just hope that this webinar was really useful and insightful for you in your investment journey. And yeah, just wishing you all the best in your investment journey with fsm1.com. Thank you.